we have a major asset class bubble break in the stock market, the money will flow elsewhere, and the central banks will try to fight that best they can. And their only tool is monetary excess and artificially low rates. What's the primary beneficiary? Historically, it's always been gold. This time it's going to be gold again. And so to see gold make another eightfold move would be, so what? That's a norm. This time the crisis is going to be even worse. So, there's a lot of guys out there who are fundamental analysts of gold that I have respect for. They may not be good at timing, but they're good at their macro views. They're talking $20,000 gold situation. Wouldn't shock me. I think it'll go off the page. The key is to break the bubble that is pending in the U.S. stock market. When that occurs, all the dynamics shift, and gold won't go 2 steps up, 1 step back anymore.
Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Looking at investment, long-term investment assessment in the U.S. market for going back 100 years, and people seem to think that, you get a 2-year bear market, buy it. Well, in fact, that's true. But a lot of the bear markets, which are 2-year drops, 2000 to 2002, you had 82% drop in NASDAQ. 2007 to 2009, S&P went down 50%. 29 to 32, 2-year drop really. You went down off the page. It was like 80% collapse. That wasn't the issue. It wasn't the duration of the bear. The problem was in getting back up to, if you're an investor and you didn't get out to avoid the collapse, waiting to come back to break even again took a decade and a half or more in so many cases that it's common. So even if you look at, let's say, just pick NASDAQ in 2000 top, it broke 82% by late October of 2002. Was it a buy there? Yeah, sort of nominally it was. But when you factor in the decay in the money supply, the increase in the money supply, the decay in the value of money, so even if price goes up, this isn't really going up. But even just to nominally get back to the price high of 2002, for the NASDAQ 100, it took till 2016 for the NASDAQ 100 to regain the price it saw in the year 2000. So from an investment perspective, one needs to be aware not of the notion that, bear market, it's over quick, get long again, the game's on. No, it's not, especially when a bubble breaks. And this is the biggest bubble in U.S. history. So when it breaks, expect the depth to be serious, but the recovery to be protracted. What has benefited in each of those time periods? Gold. The short end, the Fed fund. You go out to the 30-year and it's a different monster. It doesn't even care about the Fed. In fact, if you look at T-bonds, when the Fed cut in September, they peaked and went down. What did the stock market do? Shot up, since the Fed rate cut. So T-bonds went down, meaning yields went up on the 30-year. Fed funds rate went down. The T-bonds don't care about the short end of the market. They're the long end. They're beyond the Fed's control. And that's reflective of a major bear market underway in U.S. government T-bonds, meaning an ongoing rise in yields. The problem is that technically speaking, if you're a bear in the bond market and expect, a government debt crisis to come because of, the government debt ratio to the GDP, the increase in government, it's all those numbers that we all know. Yes, that crisis is coming, and yes, it could lead to a disaster in the bond market. But from our technical point of view, we see a counter trend rally potential in the T-bond market, meaning a drop in rates and a flush into the T-bonds. When the money moves out of the stock market, our bet is, when you break the stock market 2% off its high, I'll bet T-bonds are starting to surge. Now, already bonds have tried to come up off the low of a month ago, and they've come up fitfully, sharply, and then pulled back, and they're still fitful. But we think that there's a counter trend, sharp rally in T-bonds, but it is not a sustainable trend. It is a trading situation. So don't treat it like you would gold as a, quote, alternative that will last. It might be a trading alternative in the initial months after stock market breakage becomes obvious, where people flee and they go to what? Hey, T-bonds, right? That's safe, okay? It isn't, but for a while it might appear to be. And gold. So I wouldn't trust T-bonds beyond a nice trading rally, which of course would what? It would upset a lot of the people who have a fundamentally negative view of T-bonds, and they're correct. The problem is even trends can have counter trend moves, and I think T-bonds will have one. It is not a safe place for an investor to be. Gold, I think, is, and monetary metals, and the miners. dogs that they are. They could go crazy again and go back to zero or whatever. And let me remind people, Trump, back in the latter years of his administration, when there were rate cuts going, he argued to the Fed they need to cut rates below the Europeans, get it to zero if you have to, go below zero. Should have cheaper rates than the Europeans. So he was pounding on the Fed to cut rates more than that's sort of contrary to our notion of Trump today. Now, the question is, if we get into a down stock market, will he again turn to the Fed and demand that they cut rates more so than they already will be doing? I don't know. It'll be interesting to see, because that again is not moving away from government intervention. That's increasing government intervention in the sense of, I want the government to control the price of money, an essential commodity in everyday life. Okay. Money is an essential commodity between you and me if we transacted business or a grocer or, whatever. I may not know the person I'm dealing with, but I'm making a transaction. He likes it. I like it. We make a deal. But if that money is degrading rapidly in terms of its buying power, and more you increase the money supply over every decade, it decreases rapidly. For instance, since 1950s, the money supply every decade has basically doubled, almost. Doubled. That means if you bought a stock at $10 and 10 years later it's at 20, you haven't made a penny, And if it's gained more than that, then you've lost money. So you have to factor that in. So to, again, insist that the Fed take over the cost of money and make it lower than what the market might otherwise do, God knows what level that would be, that is in effect government intervention. So we'll see, but no doubt the Fed will cut. And I suspect, Trump will encourage them to. I just said that the gold in the prior bull markets at eightfold moves is no big deal. Go back and look historically. 10-year swings here and there, eightfold from 2000 to 2011, $250 to 1920. Even from the 1976 correction low at $103, you went to $850 by 1980, 4-year period. Eightfold moves, it's common. It's no big deal. Look at a logarithmic scale gold chart. Well, our last bear low was $1,000. Okay. Well, given the things we've been talking about today, major asset class shifts, particularly if we have a major asset class bubble break in the stock market, the money will flow elsewhere, and the central banks will try to fight that best they can. And their only tool is monetary excess and artificially low rates. What's the primary beneficiary? Historically, it's always been gold. This time it's going to be gold again. And so to see gold make another eightfold move would be, so what? That's a norm. This time the crisis is going to be even worse. So, there's a lot of guys out there who are fundamental analysts of gold that I have respect for. They may not be good at timing, but they're good at their macro views. They're talking $20,000 gold situation. Wouldn't shock me. I think it'll go off the page. The key is to break the bubble that is pending in the U.S. stock market. When that occurs, all the dynamics shift. And gold won't go 2 steps up, 1 step back anymore. And again, $8,000 gold it's a norm. Okay, gold and silver and the miners have come out of a congestion zone. Well, especially gold and silver, congestion zone that prevailed for about 3 years. And for gold, it was sideways. For silver, it was a staircase to the downside. And they both broke out in March, and we give a major resumption signal, let's put it that way, not a fresh buy signal, because originally the trend started in February 2016 by our metrics. But it was a renewal signal. The congestion's over, going up. At that point, gold was moving out above 2,000 yet again, which it had done several times before, but this time it was different. We knew it would go somewhere. Silver was moving through 25, 26 zone, and since it's seen 35, right now we're trading 31 and another pullback. So we still have a process of upside, but it's still replete with those pullbacks. Gold will go up 3 steps and pull back 1. Silver will go up 4 steps and pull back 2. They're far more volatile, nasty little dog on a leash. The leash is held by gold, so never forget that. But on the upside, silver beats gold. Now, by the way, I just want to make a point to people who think the stock market is king right now. Gold and silver is up as much on the year as the stock market is. Go figure, okay? Nobody talks about that. Percent-wise, year to date, how much up, okay? Despite the recent pullback in gold and silver.
I strongly urge people to listen to what I'm saying and to consider owning gold and silver as significant historical wealth and not rely upon a dollar, which is at the end of its Keynesian fiat experiment. Why are the super private and well-informed investors draining the London Metals Exchange and COMEX of all its metal to where the London Metals Exchange has the least amount of silver ever in the history of the exchange since they started taking records? Why has 70% of all the registered silver been drained off of COMEX over the past 18 months? Why do we see in one day 45% of all the kilo bars in gold, 26 million ounces gone in one day delivered off of COMEX? Who's got that kind of bread? Why do we see 2 weeks after that 5% of all the 100-ounce gold bars on COMEX delivered off of COMEX? When you deliver a bar off the COMEX exchange, it's a one-way street because you no longer have the liquidity. But we had some very large orders recently that some of them have become public because one of the clients that I did an order with wanted me to tell the world how difficult it was for her to get $50 million out of the bank to place an order with us. It took her almost 5 days. And she wanted me to tell everyone that get your money out of the banks because it took me 5 days to get my money with threats of calling the regulators to get my money out of the bank. So anyone who pulls metal off of COMEX like this, these massive deliveries we've seen, where in one day all this stuff is disappearing and this bleed down of supply, normally they would take it out of one category called registered. Those are the bars that can be delivered, and move it into eligible. Those are bars that they're eligible if I want to put them into register, but they're not for sale. They're mine. I'm hanging on to them, not for sale. And that's what a lot of people would do. They would just keep them in an eligible category. Well, instead of doing that and leaving them in the safety of an eligible category, that means if one of my clients who has a whole bunch of 1,000-ounce bars wants to sell them and take advantage of Elon Musk's generous offer, we could transfer them from eligible to registered, and Elon could then take possession of them. Registered means all of the numbers are already validated on the bars, the weights, the bar numbers, the authenticity goes from eligible to registered. He can take possession of them and pay me my money, but not if they're not in the COMEX ecosystem. So when all of this stuff is delivered off of COMEX, it's a big deal. Where's it all going? There was just an article by Reuters and Bloomberg, and it said that the central banks bought a record 399 tons of gold worth over $20 billion in the third quarter of 2022. 340% higher than Q3 2021, almost double the previous record of 241 tons in Q3 2018. But Bloomberg called the buyers of all of this gold and silver mystery whales. And they postulated that the mystery whales buyers were likely either China, Russia, Saudi Arabia, or India. And they also noted that the central bank purchases were nearly double the previous record. So what do all of these countries have in common? Yes, they're BRICS. So you are seeing massive drawdowns, huge amounts being drawn down off the exchanges. And it's a one-way street because once it leaves COMEX, it's lost its liquidity. These deliveries, these massive drawdowns in metals, it's been happening since I started talking about the others in 2020. It has not stopped. In fact, it's increased massively. And who's been buying more gold at any time since 1967? Oh yeah, the central banks. Why are they buying gold and silver? Oh yeah, gold's tier one reserve asset, and everyone's moving away from the dollar. And you see how all of these things start to come together? I think we often take the dollar's reserve status for granted, simply because we've grown up under this system. But the truth is that reserve currencies come and go every 100 years or so. And the dollar was the only choice when we moved to a full fiat currency system because of Bretton Woods and the trillions of dollars that had all been circulating globally. But I think that we are looking at a period of time right now where these countries are beginning to break away and accentuate themselves against the centuries-old Western dominance. I think the handwriting is on the wall. We will wake up at some point, probably sooner than later, to a new system that will challenge the dollar for its world reserve. You already have China saying to Russia that we are ready to get serious right now and build the energy infrastructure with Russia and the other BRICS nations. You can see it. It's happening. And when that announcement is made and OPEC and Saudi Arabia dump the dollar as its sole settlement currency, and all of these countries on the planet who have had to own dollars for 50 years start to sell them because the dollar becomes a hot potato, this is your great reset moment where the dollar comes flooding home, creating massive inflation, hyperinflation. And the byproduct of inflation is higher interest rates to compensate for the loss of purchasing power. I really do believe that if you are not a contrarian, you will be a victim. I really do believe that if you are fully invested in dollars, you're destined to go broke. And I want people to know that when I talk about gold and silver, it is never, ever, ever, and go back and listen to anything I've said for the past decade, gold is not an investment. Silver is not an investment. It may perform like one, may make you wealthy, but they are wealth. 5,000-year wealth that has outlived every world war, German hyperinflation, the Great Depression, and every pandemic. And when you see the most well-funded, well-informed, influential traders on the planet accumulating the stockpile of metal that they are, when you see a company like JP Morgan, who paid a $920 million fine to the Justice Department for suppressing gold and silver, accumulate over 45 million ounces of gold and 1.2 billion ounces of silver, the largest physical position of metals ever owned off their books. When you see the most sophisticated, well-informed, influential traders on the planet massively accumulating metals and de-dollarizing, whether it be the US commercial banks or the foreign central banks, when you see the rise of the others, the most influential and well-informed private traders draining the London Metals Exchange, draining the COMEX, when you see gold reclassified tier 1, when you see all of these countries coalescing, when you see all the 13 OPEC producing countries on the Belt Road, the US isn't part of it. When you see 200 countries at the IMF from around the world say we want a new system, why did they choose gold as a tier 1 reserve asset? Why not special drawing rights from the IMF? All of these things put together in and of themselves, okay, put them all together and look at it as a sphere. And you can see the dollar screwed. You can see the West is living on borrowed time. When you see all of this stuff together, if you don't see the fact that being in dollars fully and exclusively is a very bad idea, then you're not looking at the world the way that I am. And I think it's just a matter of time before people in this country have a religious experience, because when the dollar gets dumped by OPEC, which it will, you can see it. You can see the fact they don't even take Biden's phone calls. They are joining BRICS. They're moving away from the West to a massive majority of human population that is not going green. It's coming. And this is why you own gold and silver. It is wealth. This is why they're buying it, because it's wealth. It's not an investment. It's wealth. And I strongly urge people to listen to what I'm saying and to consider owning gold and silver as significant historical wealth and not rely upon a dollar, which is at the end of its Keynesian fiat experiment, and it's coming to an end, and I think it won't be a pleasant experience.
Don't forget to hit that like button. It really helps out the channel. And if you want to stay updated with more content like this, be sure to subscribe and click the bell icon so you never miss a video.